Hello and welcome everyone to the Capitalmind Podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capitalmind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to a new episode of the Capitalmind Podcast. In today's episode, we confront the amazing problem statement. Your ESOPs have finally cashed out. Now what on earth are you supposed to do with all that money? In a world where there are multiple solutions and advertising campaigns about SIPs, which are all the rage, how do you think about investing a large lump sum when it finally shows up? During this episode, Deepak will go over taxes, paying off debt, especially how to think about housing loans, saving for current or future kids' education, how much you need to retire, what not to do with your money, and how to think about consumption. So do listen in. Well, hi Deepak. And in general, we've had a lot of bad news coming out of the startup sector over the last, maybe a year, if I could put it that much. I mean, there's been layoffs and then worse in some cases. But recently, I think in the last month, there were two blips of very good news, which impacted a lot of people. Both Flipkart and Swiggy announced, I guess you could call them stock options buybacks or ESOP purchases, which total to very large numbers. I think in Flipkart's case, it was over $1 billion or something like that. And the Swiggy news, which didn't become as popular, was still very sizable. And this got me thinking that we keep thinking about SIPs as the dominant way of investing in markets. But if you think of ESOP buybacks being one way of creating large lump sum amounts of wealth, this creates, if I may call it, a sort of generalizable problem where you've now got this large lump sum and you now have to figure out what to do with it. And in fact, rumors were that all real estate prices in Bangalore were going to start shooting up because there were so many, I guess, Flipkart millionaires from this batch or whatever. And so I thought we could bring you in this time to talk about this use case, which is you've got this lump sum. And it doesn't just need to be from a stock buyback, right? It could be your startup has exited, or it could be the case that, I don't know, you've inherited a piece of land or whatever, or a long pending family thing has finally been sold and you've got a lump sum. So this lump sum has showed up. You're happy. What do you do next? What's the right thing to do with my money? I thought that's the question I could present you with.
That's actually a great starting point, I think, Shray. I think one of the things is we have to understand that there are two aspects of this. First is the very boring aspect. And I'll go through the boring first because it's easier to end on a good note. But the first and most interesting part of this overall phenomenon is that the fact is if you received a large lump sum, and we're talking about lump sum investing, that lump sum probably comes with a taxation impact. And it's different for different kind of things. Most ESOPs, you tend to say, okay, India has complicated laws on ESOPs. So the minute you exercise the ESOP, most of the income that you make from it is usually taxed. So you have to actually buy the share, convert it to the ESOP to a share. And then the company buys back the share. Now, there is a income tax to it, which is like a regular salary, perquisite kind of thing. And there's a capital gains aspect to it. If you exercise it at roughly exactly the same time as you sell it to the company, then the day you exercise it, the exact time that you exercise it is considered your perquisite value. In the sense, you might have, the strike price may be 10 rupees.
Let's use that example. So strike price is 10.
10 rupees. And the current valuation of this company is 200 rupees a share. So the 190 rupees is effectively considered income for you on the day you exercise. So therefore, the company will say, on that 190, yes, you pay me 10, but on that 190, please also pay income tax on that amount. And then when we'll buy it back from you at 200 rupees because that's the current valuation. So you pay no capital gains. You bought at 200, sold it to me at 200. So that technically there's nothing. In most other companies, the exercise price could have been done a lot earlier. So it could have been exercised at say 50 rupees. And then you actually paid that 50 rupees at that time. It was not 50 rupees. You paid 10 rupees. You paid tax on 40. And then you kept the shares in your demat account. And then the company does a buyback at 200 much later, then you pay a capital gain on the 150. Now this capital gain can be short term or long term. Now the short term capital gain is less than 2 years of holding for an unlisted, less than 1 year of holding for a listed company in India. So you essentially let's say it's a 2-year gap. So if you've exercised 2 years earlier, which is what most founders would have done, they own the shares already. So when there's a buyout for their shares, they pay long-term capital gains tax on that amount. This is also where it gets a little more complicated. Okay, so the founders that have sold shares, many of these founders have sold shares to companies who have given them shares as a swap. Now, a share swap does not mean your obligation for taxes goes away. So if I own a company that is, let us say, valued at 200 rupees per share, and I have, I don't know, 1 million shares. That means I'm going to get 20 crores for my million shares, which is 10 lakh shares. 200 rupees per share is 20 crores. Now, this is great. But the company says, listen, you know what? I'll give you 15 crores worth of my company shares. And I'll give you 5 crores worth of cash. Now you're thinking, this is great. Okay, I know, you know what? I'll have to pay tax only on the 5 crores. The answer is no. You have to pay the tax on the entire 20 crores. The way the income tax department sees it is that you got 20 crores. You use that 15 crores to buy another company's shares. And therefore, I don't care about the fact that you bought another company's shares. You've got 20. The minute value of 20 has been transferred to you, whether it's in the form of shares or cash, you have to pay tax on that entire 20. That means you're going to now take that 20, you pay 30. Depends on, it's a long-term capital gain. Let's say 20% of 20 crores is 4 crores. You got 5 crores in cash. You're going to pay out 4 crores out of that straight to the income tax department. You're left with a little bit. Net of surcharge, you're probably left with only 40 or 50 lakhs. Now, it's not as rich because you thought you could buy, a Maybach, and now you can pretty much, buy one of the smaller Skodas or something like that. So you've downgraded because the remaining 15 crores that you're supposed to have received is in shares. Now the issue is also the share consideration is on the day of your actually signing the agreement. So if your company that you've bought is valued at 1,000 crores and you received 15 crores, that means you got 1.5% of that company. This is all great, but now because times are bad, the company is now valued down to 500 crores. Your 1.5% of that company is now worth 7.5 crores. But you paid tax on the 15. So now if you actually sell your shares at 7.5 crore valuation, you only get a loss that you have to find another way to offset by having a capital gain at a later date. So it's complicated, the taxation concept. So your lump sum that you got, your exit that you got may not actually be as high as you think it is after taxes. And the complexity of it has another nature to it. Now, the headlines that you mentioned, you have a bunch of things that you can do in terms of owning, let us say, a house. Just to say that these articles said people will buy houses. Now there is an out in the income tax law that says if you have long-term capital gains, you can offset them by buying one and up to 2 houses. That means if you already own one, you can buy another house. This is to promote housing in general, or because it's good for GDP or whatever it is. But it's generally an unfair thing because you can't buy another company's shares. I can buy only a house. So assume that you do buy a house for yourself. You need to have long-term capital gains. It can't be short-term. Short-term capital gains are not offsettable against house purchases. So you'll have to still pay tax on that short-term capital gain on whatever you've received and use the remaining money to buy a house. Whereas if you buy a house, it will have to be... So right now in this budget, for instance, they've actually limited the amount to 10 crores. So you get 100 crores. You can't buy a house worth 100 crores and say, I have a long-term capital gain of 100 crores and therefore I will offset it by a 100 crore house. Now they say the limit of the taxation, the gain, if you may, is also only 10 crores. That means if you buy a house worth 100 crores, fine, but pay tax on 90 as if it was long-term capital gain itself. And then the first 10 crores is free of tax. So the taxation impact is complicated and it will change based on which year and the taxation laws that apply. But it could be that it's not that your end receipt of money is not as high as you think, especially if you're in a startup and you're a founder and you've owned shares and you think that you're getting a payout but the other company is choosing to give its own shares as collateral against, or as an exchange, you actually may not be making quite that much because typical deals are 30-70, 30% cash, 70% shares. And the reason they are that is because 30% goes as tax. So net you're out of pocket and you have to wait till this other company that that has bought you finds an exit. why is that any different from you finding an exit in the first place? But, whatever the reasoning is complicated. Sometimes it's just distress. It's because everybody just wants. And the funny part about it is some of these cases, the VCs don't take the shares. They get the money. Because they're like, oh no, what, we have LPs, we can't own shares in this company. So the acquirer says, fine, the VCs will pay full cash, but the founders will pay only 30% cash. A little unfair, but sometimes you have to take what you get versus, languishing or not doing as well in the company that you're in as well. So I think the rules are complicated on the taxation front, but this is where, once you find out what you actually have, then you can say, okay, what can I do with it? Again, I'll do the boring parts first.
I'll just pause you here. I just had one perhaps concern, which is that it does seem a bit unfair that ESOPs, which are a form of very deferred compensation, are taxed as income rather being taxed as capital gains. I think that does feel very unfortunate.
It's a very weird aspect of the income tax law. Earlier it used to be very... So there's ESOPs go through various phases. There's a grant, there's a vesting, and there's a exercise. And then there's a sale. And it does not mean that the products that you own or the ESOPs that you own, the day of grant, it's like telling an employee, listen, I will give you up to 0.5% of this company over a period of 4 years. So the grant is of, say, 100,000 shares. Now, you think you own 100,000 shares, but obviously you don't own them. Now, the first quarter, you get maybe 5,000 shares. And the second quarter, you get 10,000. It's a vesting schedule. There's usually sometimes even a vesting cliff that says the first year you get nothing. After the end of first year, you start to get your first vesting comes in. So at the time of vesting, there's no taxation for you. There's a taxation for the company, and we can come to that separately. Or maybe that needs a podcast by itself saying why does the company give ESOPs? But the at the time of vesting, essentially what the company is saying is, if you want from now on, you pay the strike price of the option. Now, whatever that option is, it may have been given to you at 10 rupees per share. You can pay that 10 rupees for 5,000 shares, pay 50,000 rupees, take the shares into your bank account. This is great, but nobody wants to pay 50,000 rupees at that time, saying, listen, what am I going to do with that 50,000? I'm just going to give you the 50,000 and then what? Wait forever? When I can wait without paying the 50,000? Fine, I'll wait without paying the 50,000. So they don't exercise. Exercise is actually when you say, my options are vested, let me exercise them. At the time of exercise, there's a tax event. The tax event is, he converted his options into a share. And the share has a value. You have a valuation certificate because you raised money in some round. At what is the value per share then? That value per share is considered effectively income from the strike price, which is 10 rupees, to maybe whatever you exercised at, which is 100 rupees. So I know that this sucks, but since it's a form of compensation, the income tax department says, well, you know what, this is like income. This is like paying the guy a bonus. Now that he's owned the share, he has not sold it. From now on, it's capital gain. So it's like saying, listen, you took a risk now. Till now, you weren't taking the risk. You had an option. You didn't have to pay for it. There was no risk that you were taking. Why am I giving you a benefit on taxation when you're not taking any risk? You're deferring your compensation, but it's compensation. When you get, it's like me saying, oh, don't give me my bonus this year, give it to me next year. Does that mean that I'm not liable to tax next year? The answer is no. The answer is I'm still liable to tax whenever I take the money. So the compensation part of it is taxed as income. It's the risk that you take after you own the share that's taxed as capital gains. And that I think is fair to a certain extent in terms of, but it's really, it screws things up because not everybody thinks like this. They're like, dude, I got this share at 10 rupees. It went to 100. I stayed with this company so far. Why are you taxing me like this is income? Didn't I take that risk? But the answer is no, you didn't take the risk really, because you should have bought it at 50 when it vested, but you chose to exercise it only when it was 100. So therefore, you're going to pay tax on it when it's 100. It's just the nature of the beast that, kind of screws things up.
You were saying more boring stuff, I get it. So
Yes.
the person has got what we thought was a decent payout, but apparently a lot of it can go in tax, and if the payout is more than 5 crores, then 39% is the highest margin.
2 crores now.
It's 2 crores. So
2 crores plus is 39%.
39%, which is painful. Well, at least it's not 43 as it used to be a
it
year
used to be
ago.
43
Yeah.
last year. So
Okay.
we're
That's
lucky.
something.
So I don't know what that means, but anyway.
Sure.
But okay, so
What's
let's
the
say,
next thing?
Yes.
Yeah.
So now let's say you got a payout, and that payout is 5 crores after all these tax business. You're thinking this 5 crores is a fantastic amount. And I will tell you, and in the most boring way possible, why this is not a fantastic thing. Because if you're somebody who's made 5 crores, suddenly you're thinking my lifestyle can be upgraded, I can live in a better house or whatever it is. And I will come to each of these aspects on it one by one. So the first aspect is, what do you need to do with this money and most likely you haven't saved too much money, or you've saved some money and all that stuff. So take all the money you have, including this 5 crores. Let's say that total amount is 5.5 crores because you only had 50 lakhs so far. And I will tell you that the first thing you should do is create an emergency buffer. And you live in a startup world. Things can change anytime. You have a situation today where they're saying 88% of people who have been offers that were more than 50 lakh rupees per year as salary have come down by 88% in the last few months. Now, the complexity of this is, if you're in that zone, you're already thinking, listen, if I lose my job, I'm not going to get a job at the same rate. So what I should do is keep about 6 to 8 months of my income in some place that says it's going to take me 6 to 8 months to find a job. In those 6 to 8 months, I need an emergency buffer to dip into. This is beyond all the health insurances and all that stuff that you anyway need to have. This is just working capital expenses in a way, work or living expenses. So assuming that you spend, maybe you spend 1.5 lakhs a month today, and tomorrow, because of your relatively better lifestyle, because you want to spend 2 lakhs a month. I don't want you to lose that lifestyle if in case you don't have a job. Therefore, you should save 2 lakhs a month into 6 or 12 or whatever it is. So let's say you decide 10 months of income. That's 20 lakhs that has to be segregated from your entire corpus and kept into an FD or something really boring and all that. Now, this is where you shouldn't optimize. You shouldn't say, I'm getting 7.5% at some shady non-banking finance company ka FD at some startup that is selling shady non-banking company ka FDs. So you'll be like, dude, you know what, this is my emergency money. I don't want to have to go and say, what does this company sell? What does this company do? Oh, no, it sells batteries. Then what happened? Oh, no, the batteries didn't work out. What about my money? It's good. You got to wait a little bit. No, I have an emergency. I need the money. Well, you know what? Go to the public sector banks or just a bank, private sector bank as well. Just keep the money in an FD if it doesn't.
Even Yes Bank FDs worked out?
I think Yes Bank FDs have all worked out. In fact, there have been no failures in deposits in scheduled There are only the non-scheduled banks called cooperative banks where people have lost money. And again, that was like the 9% deposit rate when everybody else was offering 7%. So you should be a little wary of that. So this is money on which you'll get almost no interest. So keep that aside. Once you've got this, the biggest thing to do, probably even before the emergency fund, the thing that you might want to do also is to pay back some of these expensive loans that you might have taken in the process of, doing whatever. Because, having an emergency fund and then getting 7% on it or whatever, and then having these loans in which you have some obscene amount of EMIs to pay is a little bit counterproductive. So you want to reduce the high interest rates. The biggest thing is your credit card. Credit card charges you an insane amount of debt. So pay it off in full. And secondly,
3% a month or something, right?
Nowadays 3.5, so 42% a year effectively, but it compounds on a monthly basis. So after compounding, it becomes so big that, every bank that's issuing a credit card should technically be the king of Russia, but, it's not. So the interesting piece of this is that if you do this, you will actually reduce your outgo because your EMIs come down, but that's fine. You lose some of your capital. So credit card debt is the number one. There may be an auto loan. Auto loans are fixed, so you don't gain anything if the interest rates in the market fall. So get rid of them if you can. Again, there is a complexity. You may not be able to get out without a 3% penalty, but you could work with your bank and talk about things and all that stuff. And a lot of loans like this.
Since you've brought up loans, should you just pay off all loans?
That's...
And I have another thing, but you can bring it up later, which is that that house thing we were just talking about. What if you already have a housing loan out? Is this now a time to repay this housing loan?
Yes, so this is a great question. And people talk about this all the time saying, you know what, my housing loan is at 8.5. But the market and the last 3 years have confused everybody. So right now, everybody's thinking 20% is like a minimum kind of guaranteed thing. But assume that even if you think of 12%, which is the long-term return of the Nifty, you're thinking 12% I'll get in the Nifty, or I'll get a fixed deposit at 9% and I have 8.5% in the housing loan. So obviously I'm making money. The answer is no, you're not making money. I'll tell you why you're not making money. Most likely your loan is a large amount. It's a 50 lakh, 60 lakh, 1 crore kind of a loan. And the tax benefits on it kind of end after the principal crosses 25 lakhs. There's almost no further benefit after the 25 lakh number. So because of that, you're not getting any major tax benefit on this 8.5% that you're getting. But the interesting part of this is that the 8.5 lakhs that you're 8.5% that you're paying is coming from your post-tax income, because you have to pay tax on whatever money you receive and then pay this money. Now, if I invested in something that's making 9% as an FD, just as an example, that 9% is considered income, and you're now in, let's say, a higher bracket, say 35%. A 35% bracket means 9% after tax becomes, 6.5, roughly, 6.7%. If you're making 7% post-tax, now you have to pay 8.5% on the housing loan. That's a net negative proposition, right? So it's only if you invest long-term in equity and you wait till you get this 12%, and the equity capital gains is only 10%. So 12% becomes 10.8. That's when it's useful. But that doesn't solve your cash flow problem. You're still paying out 8.5 while the market could take 5 years to make that 12% gain per year. So I would say don't pay off a housing loan. Or rather, don't think that you'll keep a housing loan because the interest rates are in your favor. But I would say think about it from a practical perspective. Home loans up to 25 lakhs, you get a tax benefit, keep it. So, because 25 lakhs is roughly at 8.5% is roughly 2.2 lakhs of interest. 2.2 lakhs of interest, up to 2 lakhs of interest is offsettable against your income. So if you have income from another source, this 2 lakhs can be wiped off of that in terms of taxation. So you pay lesser tax. Great. Anything above 25 lakhs in terms of principal outstanding, you can pay back. And I would say do it unless you are incredibly sure that you can make a significantly higher return than say 12, 13, 14%. I don't think you should. And plus, if you're a person who's made his money from non-financial sources, the chances that you'll be able to make a guaranteed 15, 16% are relatively low. So I would say, up to 25 lakhs pay back, keep the home loan. But beyond that, don't. If you have more than 2 houses, it won't matter at all. You can't even save. And this housing loan concept, the reason it's been brought down in terms of rates is not because people want you to, the banks love you that when you buy a house or anything like that. Even if I gave a house as collateral and took a loan to start a business, I would get a 14% loan. So it's because RBI has decided that people taking a loan to buy a house should be somehow given a better feeling than people who give collateral of a house and use the money to do something else. Because what happens is there are risk weights. There are different risk weights for different types of loans. A housing loan is a loan given to buy a house, and a housing loan given to buy a house can be has a much lower risk weight than a loan that is used. It's called loan against property. So a loan against property is a different risk weight. So you end up with a higher, consequentially higher capital for the bank, and therefore they offer lower rates on housing loans. So I would say just consider that carefully. The one kind of loan that you could take, and this is some loans that banks offer, is a floating, what is called a overdraft kind of a loan. It's called SBI Max Gain. SBI has an SBI Max Gain. A bunch of them have it. Here the interest rate is slightly higher. What they do is they say, listen, if you have a 1 crore loan and you park 75 lakhs in that loan account, it's effectively a new bank account with a negative balance of 1 crore rupees. And if you park 75 lakhs in there, then only 25 lakhs is the outstanding amount. So every month when I calculate my interest, it will be on the 25 lakhs, not on the full 1 crore. So your EMI, it could be 10,000 rupees or 20,000 rupees a month. Roughly 300 rupees per lakh is or rather, if you take a 1 crore loan, your EMI will be about 90,000 rupees. That 85,000 rupees will consist of the principal part is the bigger one, and the interest part is the interest on the outstanding, which is 25 lakhs. So you pay a much lower interest component, higher principal component. So your loan gets paid back in much faster time than if you did this other way. This is actually good. You know why? Because tomorrow you could have an emergency, and this could be your emergency fund, because the 75 lakhs is amount that is sitting in that account, but it's usable. So you can take out 5 lakhs out of it, and then the outstanding becomes 30. So as long as that is there in place, I don't think there's a problem. So the good part of doing something like this is just a restructuring of it. It makes sense if you have relatively smaller amounts. So for instance, if you make 100 crores and you have a 1 crore housing loan, do you even want to have this discussion? It's like, Deepak, this is a waste of time. I'll just pay back the 1 crore and I'll still be left with so much money, I don't care, right? So all of these things are what I call micro optimizations, which matter if you have smaller sums of money, but at larger sums of money, they don't make a difference. It's like,
Can I give a more, you got a payout after taxes of 3 crores and your housing loan is 2.5 crores.
Yeah, then you want to micro optimize, or you want to.
Then I guess pay off half. That's
pay off half. You could do structure it like saying, I don't want all my liquidity to go away. Housing loans are actually good loans. I mean, in general, it's good debt because it's for an asset that you feel good about. It is not for an investment, but it's for an asset that you feel good about. It's like a car. I think even car loans are good loans. What are bad loans? Credit card debt is a bad loan.
Education loans?
Education loans are decent depending on the kind of education that you're doing. But in general, education loans may actually be better than housing loans because the house will not give you back anything other than maybe the fact that you love it. An education loan will actually make you employable, give you more income. So I would rate education loans as the highest form of, the best form of loans. And then you get the housings and the maybe a business loan or a car loan and things like that. So you'd have a hierarchy of things that you want to do. But I would say in general, paying back a loan is about the amounts and how much you're comfortable with. In the end, you should have this only one clear thing. Your EMI should not, in general, go up beyond 20% of your income. So if your income is 1 lakh a month, the EMI should be 20,000. Now people say 40%. I think that's too high. I think 20% is manageable. You can live with an emergency buffer. You get enough to spend at the end of the day, and you can't stop the EMI. So in the end, if things go badly, you will stop all the other expenses before your EMI, before you cut down on your EMI. So you want that EMI to be as low as possible. So keeping it at 20% or less than your take-home, salary, I think that is how the structure is.
My next 2 points that I have over here. The first is, what is your view on saving for your kids' education? Assume they're college, because school should just be paid out of your salary, presumably. And the next one is on, let's say your payout has been a bit larger. How do you start thinking towards building up that retirement corpus or whatever, or life fund, or whatever the phrase you use?
So once you cross the emergency barriers, right, then you get, those are hygiene elements. You removed your high interest debt and all that stuff. Now you're coming into a point where, okay, what do I do for? So first thing I'd say, people do think about buying a house as an investment, but I think step away from that and buy a house for personal good feeling. This is a house that you live in, so it's not an investment, but it's something that you live in, and it's like a car. You own it not because taking an Uber is less or more expensive. You own it because you want to get up on a Friday morning and say, I'm not going to work. I'm going to drive around to, I don't know, Coorg and eat pandi curry or whatever it is. It's like it's that way of life that attracts you. And the same thing for a house. I want to nail something on the walls. I don't have to ask my landlord for permission. Great. I like that feeling. Therefore, I should own a house. This is why you should. So keep that in mind. I think, yes, you should. The taxation element may not apply to about 50 to 60% of these lump sum people. And too many people end up making money from real estate itself. They want to put the money back into real estate, despite having like 2-3 houses. After one house, everything else becomes the surplus work thing, right? So you don't want to introduce work to your... We'll come to that in a later point.
No, I think that's fair. Your point is that, look, if you're great at real estate, then by all means, create many tens or hundreds of crores real estate empire. You'll probably do very well. You're clearly better at this than, say, I don't know, stocks or something else. But unless you're that person or aspire to be that person, maybe this isn't the best use of your resources.
Yeah, and I found people that, for me, it's personally not worked out. But I think also that there are lots of people who find this a hassle. It's like, dude, I'm in a holiday in Goa, and then my tenant is calling me and saying, sir, ये geyser नहीं चल रहा है. I'm like, I'm in Goa. Now I have to call up some plumber somewhere and tell him that please replace the geyser or whatever it is and all that stuff. This is not how your FDs work. No banker calls you and says, sir, FD mein na, there's some 2 decimal points missing. So you're like, deal with it, dude. It's not my problem at all. They're less hassle-based investments, right? So you end up wanting less hassle as you get richer and richer, and over a period of time, unless real estate is a business, And for it to be a business, you got to diversify, have 10 houses, and things like that. So, for instance, I think probably one generation up, the founders of companies that have listed in the past and all that stuff, a lot of them have lots of real estate. They have 100 houses, 400 apartments. That is a business that you can employ like an organization to handle. But when you have to fix the geyser, then that's a big problem, right? So you want to reduce that. I think the next part, and once you got a house, this is the good, nice, happy feeling funda. But you also have to plan for, say, your kids' retirement, your own kids' education, and so kids' education. It's complex here because, things have changed. When I started off, I'll tell you, when I was on a drive to Goa, in Goa, we were, it was 2006, and we had just realized our first, baby is going to come, and it was about 3 months in, and then we were driving, and we said, we should start saving for his education. So I started making lots of plans and Excel sheet. I still have that Excel sheet. So it's like a very complex one. So I said, okay, for school, for pocket money, for this. And I said, school and pocket money, forget it. It's just part of life. We'll just pay it off as we go. But college is this one big expense that comes, and it comes bunched in these 3 or 4 years. So you need to really plan for it. And I don't want my son to take an education loan and be hassled with a loan the minute he starts a career. And I was like, okay, no, we should plan for that. So what did I put as numbers? I said, okay, schools are X. That X has become 4X because I've changed the kind of school my kids are in and all that stuff. But over time, I realized the college expenses are more or less about the same in US dollar terms, the highest end, as they are today. So when I went to college, my college fees, because I went to a government school, was like 10,000 rupees a semester. And that's the highest semester ever. I used to have some semesters with only 2,000 rupees or something like that. Now, the same college costs, I think, 1 or 2 lakhs rupees per semester.
It's still not terrible.
It's still not terrible. And this is still government funded and all that stuff. And the private colleges are probably 5 lakhs a semester. So maybe for 10 lakhs a year for engineering, the highest.
Yeah, now this is adding up though.
This is adding up, yeah. Well, and medical colleges are maybe, 15 lakhs a year or 20 lakhs a year in India. But if you went abroad, you would end up with this more complex.
It's like 50, 60 lakhs a year.
So assume $50,000 a year in the US is pretty much the lowest end of the thing. And then you have up to 100,000, 150,000. So keep the 50,000 as your target base. And now you're talking 40 lakhs a year. So 40 lakhs a year into 4 is 1.6 crores. But that is today. The dollar and rupee rate is not going to remain the same. Assume that there's a differential of, say, 5% between India and the US in terms of inflation. So interest rates the exchange rate will change roughly at 5% a year, let's say. Assume, just to give, it hasn't actually, it's changed only about 3.5% a year. And now I think it'll be even lesser. But it's also likely that because of the inflation in the US compared to India, we'll see 50,000 go to 55 and 60 and all that stuff.
Let's just extrapolate the past. It's just 3%. Yeah.
Let's say. So if you do that, then you're at 3% inflation. And let's say your child is 6 today. In 12 years, well, see, 3% sounds a little less because mathematically I can't work out the numbers.
So maybe 3 and 3. 3 of inflation, 3 of the exchange rate.
Yes. So you got 6% right there, right? At 6%, your expenses double every 12 years. Roughly 12, 6 or 72. Rule of 72.
I know that sounds right. Yeah.
So you've got 1.6 crores today. Your son or daughter is 6. In 12 years, that 1.6 will become 3.2 crores. So now, whatever you want to do right now, you want to park some money that says, well, I will grow this money to 3.2 crores. This is not as tough as you think. I'll give you an example of how crazy it is. And if you do the calculations, so you can assume that, let us say your income from now to another 12 years will go up by, say, 6-7% a year at least. And if you're saving a certain amount of money for the child, now how much do you need to save? So today you don't need to save 3.2. Even if you saved 1.6 and got the same 6% from your investments, then that 1.6 will also become 3.2. So you could take out the entire money and say, dude, my kid's education is done. I'm putting it in a fixed deposit and that's gone. But I think when you have 12 years, putting it in a fixed deposit sounds like a little too conservative. So you have 12 years, you can use some equity for it. And I would, general rule of thumb is more than 5 years, put it in equity. Less than 5 years, reduce the equity percentage for every year and bring it to 0% equity towards the last. So you would end up with a situation where you say, if I put 100% in equity and my long-term returns in equity are 11%, then I don't need to put 1.6 crores. I can even put only 1 crore today and it'll reach there. I could put 50 lakhs and 20,000 rupees per month and I'll still get there. So there's a combination that you might say. So you might divide your corpus into child 1, 50 lakhs, now 10,000 to 20,000 rupees per month, increasing at 7 or 8% per year. I could put child 2, 30 lakhs because child 2 is younger and I have more time and all that stuff. So you might do that and say, okay, I'm going to carve out all of these elements. I've carved out an emergency fund. I've carved out amount to repay my loans. I've carved out an amount for each child's education. And I've decided what kind of equity debt allocation will come in. The one thing that maybe we should discuss these at a later point of what you should not do, but maybe we'll come to that.
I'll ask one more then. Can you talk a bit about retirement? I mean,
Yes.
we have a plan at plan.capitalmindwealth.com. We built out these fancy calculators, which now no one uses. But the numbers can get quite interesting. Of course, they become astronomically large. It becomes, you need several crores or some tens of crores by the age of 60, and it looks very intimidating. But what's the rule of thumb? There's also that into factor of 30 or something, right? That you can use. I mean, what's a simple rule of thumb to use on this? Or just visit the website?
You could go to there and visit the website. I visited the website, and because I was writing this for the book, I made this complex table. So if you're 36 years old, you need to, you're 38 years. So then I realized all these numbers sound like there's a formula in here, right? And I said, okay, I may not get it exactly right, but it's better to get it, in the ballpark than to get it precisely wrong, right? So what you want to do is a rule of thumb. I need how much? The answer that I need how much is 30x your annual expenses. Until if you're less than 50 years old today, you're less than 10 years away from retirement, you need 30 times your yearly expenses in a bank account. That will serve you well for the rest of your life, even at a withdrawal rate of 3 or 4%. To give you a rough example, it's like this, because you have to account for inflation. That's why. So let's say you want to live another 30 years after your retirement. You retire at 60, you want to live till 90. Whatever expenses you're doing now till the age of 60, that will inflate at say 5 or 6% per year. Then from 16 to 90, it will further inflate at 5% per year. At 5% per year, every 15 years, your expenses double. 14 actually. But so you effectively saying that if I'm spending 12 lakhs a year today, or 25 lakhs a year, or 2 lakhs a month, 25 lakhs a year today, in 15 years to the time I retire, if I'm 45 years old today and I want to retire in 15 years, my expenses will become 4 lakhs a month. By the time I'm 75, it will become 8 lakhs a month. And by the time I'm 90, it's 16 lakhs a month, because just inflation. The way that
I know, this is why the numbers look so absurd always.
Yeah. So suddenly somebody's telling you need like 14 crores. And you're like, dude, how will I get 14? No, it's not huge.
You didn't close the laptop and walk away.
It's not, and plus it's not so bad. So usually at 45, the numbers are a little bit lesser. It's for 2 lakhs a month, it's on the order of, for 2 lakhs a month, it's about 7.5 crores. To give you an example, 25 lakhs a year into 30 is about 7.5 crores. You need 7.5 crores to be available to you at the time, at a time that you're going to retire. So you should plan for that. Now you can plan for it by saying, again, I'll take a chunk of my funds, put it as a starting point, and then put another 30,000 rupees per month as an EMI or whatever it is. And over time, I'll build that larger corpus. This actually helps keep everything in one, it's like, again, like I said, it's boring. It's exciting to me because I like Excel. Most people don't. But it's like, okay, I put this bucket, this bucket, this bucket. It's usually easy to plan it out that way. In the end, you're like, Deepak, should I put a different mutual fund for my son's education, a different mutual fund for my other son's education, my emergency fund, my retirement? In my retirement, I also want to do this world tour for which I want a separate 50 lakhs. Should I put another mutual fund? My answer to that is, if you complicate your life that much, yes, you can do each mutual fund. So you can say, this is for my, my son's car.
All ICICI funds are for this, all HDFC funds are for this.
You could do that. But in general, I would say just put that numbers on an Excel sheet. Once a year, just plan it out, saying, boss, by 2025, I need to be here. By 2030, I need to be here. We did this in the plan.capitalmind.wealth tool, where it says literally every year it knows where you need to be. Put it down and say, are you there yet? Once in a year is fine. Because if you're not there, then in all probability, you're still earning income. You can put a little more towards it. And if the reason you're not there is because the markets are down. most likely, because fixed income will be fixed income. Markets will go up and down. So in 2020, and this is my own case, I have these buckets, right? In 2020, I realized that I am behind, and I'm behind quite considerably from where I should be. So whatever other savings I had, which I had in some bunch of boring places and all that stuff, I just took them out and I said, okay, let's put them into equity because I'm way behind. It was good because when the markets recovered, I had and I didn't mind at the time. I still have, my older son still has 2 more years left to get to a point where he has to be paid, college has to be paid for. My younger one has even longer. So you end up with this thing saying, if I have enough time, I will put more into equity at the time when I am behind on my goals and put less. So you could do this, and when you have these large lump sums, you actually have a bunch of money sitting out in FDs or something like that, just for a bunch of either it's comfort. Because I will tell you that you need an emergency fund of 20 lakhs. You're thinking, Deepak, I made 5 crores. I'll put 1 crore in FDs. Okay, so I am not going to. But this extra money comes into use when markets are completely down, and you're like, okay, I have time, so might as well take another 25-30 lakhs and put it into equity at that point, and I have the FD to grab from because I had over FD'd myself, right? So if that's a thing,
we should have t-shirts with that.
Did you? I'm an over FDR or whatever it is. So
I have one more, can I call it boring or virtuous thing, and then we can move to fun stuff. You were talking about that. What's all that stuff? I mean, unless you have anything more to add to this point, what is all that stuff you were saying, that things you don't want people to do? I mean, mine is don't become a real estate baron and start buying houses unless you're willing to set up like a small firm to be able to handle this for you with people who are good at this, or you are hopefully good at this or from such a family. But you had a few other things in mind, no?
Oh yeah, I had a bunch of things. I'll tell you what I find complicated. It's not easy to explain this because it's behavioral. But the first important thing that you have to do is, when you receive a lump sum and you're looking at investing for the long term, people will say, put it in 6 months as an SIP instead of all at once, because you'll average it out. My answer to this is, what difference does it make? If you're investing for 10 years, does 3 months or 6 months really make a difference? If the market goes up in those 3 months, you will feel miserable because you could have invested all of it in the beginning. If the market goes down in the first few months, you are only going to benefit from that relative small dip. So if markets go up maybe in 10 years, and even at 12% rate, your 100 will become 400. Does it really make a big difference to you if you started at 100 or you average down from 100 to 70, your average being 85 rupees, and that grew to 400 or 410 or whatever it is? It won't make so much of a difference for you. That initial tiny blip is not over a 10 to 20 year period. Now going to change your life. So I think also that, because it will make you feel miserable in the short term if the market goes up, but only happy in the long term if your market goes down, you are likely to, and I'll tell you what happens. This is just a behavioral thing. If markets go down, people stop their SIPs.
Well, apparently not anymore, but
not
I
anymore,
take
yes,
your point.
Maybe,
Yes.
but they get more fearful. They say, okay, let's spread it out over 12 months instead. But that's not how you should do it. You should actually. So I would say, don't bother in just. And how you manage risk is not by saying I'll put my money over 6 months. How you manage risk is, I don't want 30% downside on my portfolio. Therefore, I'll put 50% of my money in an FD, 50% of my money in this. This is just risk appetite, right? So I don't want to see a 20%, 30% down, but can I see 15% down? Fine. Then my 100 rupees, I will think of it as one monolith, but internally divided into 50 rupees into FD. And 50 rupees into
Here,
equity.
should FD can also be replaced by debt mutual fund?
In fact, it helps you because it defers your taxes. It doesn't change your taxation anymore, but it defers your taxes down to the point when you actually need the money to take out. So you could do that. In fact, there are a bunch of other funds, and that's very interesting because you have something called arbitrage funds where your taxation rate is only 10 or 15%.
That will go away by the time this podcast comes out.
Yes, most likely. They're
or
already
the time
listening.
somebody has it. Yeah.
Like, dude, whatever you said in that podcast will make it negative. But whatever it is, you shouldn't bother too much about the taxation element.
But can I just ask a question on this? Look, the reason we've had some customers who got I obviously can't name them, but they've had startup exits, right? Very substantial startup exits. And even I feel nervous saying that you've got 20 crores, let's put it all into this portfolio on day one. So I said, let's do it over 6 months. Of course, the market went up for the first 3 months. So this guy only called and just like yelled at me and said, now just put the damn thing in. So we did it. And it has been a reasonably happy journey since. But the fact of the matter is that I think your point is that manage this through asset allocation, don't manage. But the counter then I come up with is, so what if you got your exit in Feb 2020 and then in March 2020 you would have seen it fall, what would you have seen it fall? 35-40%. And then you would have lost all your nerve and you pulled out money out saying, I just made like over 10 years this much money and then I lost it. So there's one, then now this is from before my time, well not really, but the 2008 crisis, couldn't that, so are you kind of just trying to hedge yourself against those events?
I think those are the events you want to hedge yourself against. Now, the problem with this is these events don't happen as often as one would think they happen. So the exits tend to come in good times, in heady times also. That's also a problem.
Which is also just before the next crash.
Yeah. So you get the exits and then you start to put your money in the market crashes. Yes. I think the dil ke behlane ko wala funda, which is the ghazal that says dil ke behlane ko ye khayal acha hai, which is that you're doing this only because it makes me feel good, but not because it actually has an impact. Much as I say that, maybe I should correct myself over here and say, while the boring part of it is the finance tells you that you shouldn't put lump sum and forget about it because there's no probability advantage to putting it up. If it makes you feel happier, then do it over 6 months. But remember that if the market goes up, you're going to feel miserable. So leave enough for a stiff drink by the end of 6 months saying, listen, I screwed up and
I do like your idea of the asset allocation solves it. You don't look at the equity for a while and the asset. But I think it's certainly, I actually met a friend recently who wanted to invest a lump sum and he was advised by someone, let's do this over 3 months. That is clearly kind of pointless,
yeah, which is more like, it's work. That's all. I have to remember 3 times because these SIP people, they won't act. I don't know if they accept things like, I'll take an SIP of 10 lakh rupees, of 25 lakh rupees per month. They'll be like, no, we can't auto debit your account by 25 lakhs. Therefore, give us, we'll contact you every time, please do a transfer. Then you're in the middle of a meeting somewhere and somebody's calling you, aapka 25 lakh rupee ka transfer,
please share OTP
please share OTP or whatever it is. And you're like, okay, why? So it's just work for no reason.
Point. So can I say that SIPs make sense when the inflows are also in the correspondingly what's the right word for it? Smaller. So could you expand on that?
Yes. So sorry.
If you're getting a salary and you're saving per month, that's when an SIP makes sense.
Yes.
Right?
Income, if you balance your investments to income, I find a lot of people who say this. If I had invested 1 lakh rupees in Wipro in 1981, I would have been.
Yeah.
We bought a plot of land for 10,000 rupees in 1979. We bought a house, an entire house for 97,000 rupees in 1981. So you're telling me in 1981 I should have had 1 lakh rupees. My dad's salary was 2,000 or 3,000 rupees at the time per month. For him, 1 lakh was a fortune.
That was your house. You don't bet that on this weird...
You don't bet it on a Wipro. Yeah. They sell vegetable oils. They weren't even making computers or whatever they were.
IT services, I guess.
Yes, IT services at the time. So I feel that these things are overvalued. But yes, if my dad had invested 500 rupees per month in stocks, of course, he probably didn't have that much savings at the time, but let's say even 100 rupees a month and kept increasing it over time, that would have, because his cash flow kind of matches his investment cycle, and that's what SIP is made for.
And even today, if you're maybe you're earning an insane salary of many crores per year, then you do 8 lakhs a month or whatever is this absurd SIP you can do. I have one friend who actually does it all in PPFAS, 8 lakhs a month into PPFAS. So,
which is fair. I think, find the right investment.
The equity wala.
I think doing that is a great idea because as a percentage of your income, if that relative number is small, then the absolute value doesn't matter. So if you're making 5 crores a year, then putting 8 lakhs a month is like, ooh, okay.
Of course, why wouldn't you?
And in fact, somebody else from a fund actually today tweeted that the only thing that he's learned in the SIP thing is to don't touch the SIP.
Yeah, don't stop.
The only thing is,
I
would say
up,
increase it. Yeah, step it up, because stepping it up changes the world for you in terms of returns. So if I did a 10,000 rupee SIP for 15 years, 20 years, and I did this calculation, I wrote it in the book also, and I got 12% for it. Fantastic. reach a certain number, I think it was 20 lakhs, some crazy number like that, or even more, or 46 lakhs or something, you will get an even higher return or higher absolute number if it was 10,000 rupees a month, increasing at 10% a year. That means 10,000 became 11,000, 11,000 became 13,000 in subsequent years. But you got only 8% returns. That means an 8% return, which is like 2/3 the return I got on the other side, which was a fantastic 12% return, is less. I mean, if the 8% return is even more valuable just because I increase my SIP. So you could do that. But that, of course, we're talking in the context of lump sum investing, this probably doesn't make sense. But I would say in general, doing an SIP-ish approach for a lump sum when you have a large sum of money may not necessarily be the right thing for you.
Well, I mean, it's still relevant because even though said person who's listening to this podcast has got their lump sum, they may not have stopped working,
Yes.
right? I mean, unless it's some absurd amount. So, in fact, all our customers who got absurd amounts are still working by and large.
And actually what's happened is it's freed up their cash flows, right? Because
correct.
they've paid off their loans, they've bought a house, they don't have rent anymore. So the cash flows which were 4 lakhs a month, they suddenly come back to 1.5 lakhs a month. Now they have that extra money that they can
Yeah,
save.
and so
the
this
SIP
is
comes in.
okay. So 2 things not to do: don't be a real estate baron, and don't don't overstate the benefits of averaging in over 6 months, 12 months, or
12
something
months.
like that.
But there's a third one, or third and fourth, if I may. The third one is people look at fixed income and say, ki, yaar, you know what, I'm only getting 6% or 7% here. Why don't I put it in that, again, the startup which does fantastic. Oh, they have 11% product by this random name, very nice company, whose name I have heard of, but I actually don't know what they do.
And they have a nice looking app.
They have a nice looking app. So, like, okay, but why? No, I divided my asset allocation into fixed income and equity. And then I went into really shitty fixed income. Why would you do that? It's like, no, take the risks on the equity part where at least you get more money. 11% is considered ordinary in equity.
Table stakes.
In equity, and it's considered insanely great for fixed income. Why would you take that risk in fixed income itself?
Why do people take it? Because I know there's startups who have actually sold as a startup, they've exited, and they seem to specialize in just selling people shitty debt with a good UI. So
yeah, I mean, so the genesis of this is perhaps the Kitna Deti Hai funda, which India has
fair,
forever.
fair.
Yes.
Yeah.
But the other problem is that people love fixed part of fixed income.
Yeah.
So I know what I'm going to get versus if you come to me anytime and say, Deepak, how much do the equity markets give me? My first answer is, I don't know.
It's like, how much have you got in a portfolio? Depends. Did you start 1 year ago, 2 years ago,
3
3 years
years
ago?
ago? Yeah. So it's all a function of you cannot guarantee it, and people want that so that 11% sound. So 11% is like that. I don't know what. So at 12 to 13%, and I'll tell you this. For instance, a company like Bandhan Bank, the one of the most respected banks in the country. Bandhan was this massive microfinance company. Bandhan, before it became a bank, I think it was before it became a bank. I don't know this exactly, but what happened, or no, it was after it became a bank. They had extra money. They went and gave it to ILFS, which was one of India's largest infrastructure firms that was failing. Now, why did they give it to ILFS? Because ILFS was offering 11% or 12%. Now, why would a AAA company offer 11 to 12% when all other AAA companies are offering 9%? The answer is, oh no, we don't know. So, even a company like Bandhan, when it got a lump sum of 400 crores, which is great, because a bank having money means it can actually lend it out to people, right? Rather than, but it went and parked that money with an ILFS at 11%.
What happened?
12, they lost it.
Wait, really? All
yes,
of it?
It's gone for the most part. Now
of
it's coming back over a period of, I think, next 5 years they'll get back some of that money. But the problem is, this is just our innate philosophy, right? We love...
You're right. This Ed Thorpe, right? That's the guy who writes all those books. That guy who was great at gambling or whatever. He wrote this fantastic book. He said that your expense for certainty as a income is a very costly desire, and a lot of people are making a lot of money on the other side of that trade. I mean,
in fact, I think this is true of almost everything else. So the person, other than maybe a person who would be a doctor, a licensed profession like a doctor or a lawyer or something like that, where your income streams are fairly well known and things like that. Most other professions, the more certainty you have in your job role, the more limited the amount of upside is in the salary that you make in general. Because if you join a startup, the payout can be quite substantial. If you join a listed company, or a big company, there is a certain set of barriers that you have to cross, and you'll not make more than that over a certain time. An entrepreneur who takes risks ends up making a significantly higher chunk of money. So the price you pay for certainty in general is higher, but we accept that, right? So we at some point we're like, no, we don't want to join a startup because the certainty of cash flows is not there.
I think my irritation or worry here is that a poor debt product makes you feel you're getting certainty, but they're just hiding the risk
Exactly,
from you.
and that's my problem, because it's the turkey problem. The turkey is fed every day until one day it is the meal. So the problem is, every single day it feels that it is somebody.
The farmer loves me.
Yeah, the farmer loves me.
Yeah.
And then some days it's not. So this problem, and of course it came in that book. I forget.
Psychology of money.
No, it was that other fellow who wrote about.
It doesn't matter. We'll find it and put it in the
wala,
notes.
I forget his name. Taleb. Taleb's book is when I first read it, but must be an old analogy. But here's the the core of the structure. If you end up with a situation on very high risk, that's one end of the spectrum, and very low risk on the other end of the spectrum, stick with high risk part of the spectrum and low risk part of the spectrum. Don't find the low risk part that actually gives you the high risk returns, because the high risk returns means there is high risk and that risk is being hidden. That's one mistake, I think. So what happens generally, and I'll tell you this, anybody who makes money, the first thing they will get calls is from their bankers, from the investment bankers, relationship managers, wealth managers, and so on. They will get pitched the normal products. You know what? Why don't we also do this thing? And this thing is what? There is a structure which is created by Citibank in Singapore, which buys a product which sits in Hong Kong, and it gives you returns that says, if you give me 100 rupees, I will give you 150 rupees in 5 years, unless the Nifty goes up 14.35%, in which case you'll get 110 rupees. So you're like,
I used to work in this division.
Yeah, plus we've made. I'm guilty of being in the finance world, and we are both probably. But this kind of product is built because its minimums are 1 crore, and you can't, because even the SEBI and all of them have realized that these products are ununderstandable to normal human beings. Therefore, please go and give it to the rich people. So, guess what? The rich people and engineers like me who love Excel are designing such products, and we're giving it to people. And then people are like, "This sounds intelligent. You're wearing a suit, so you must know what you're doing." And therefore, so this is the kind of stuff you should absolutely not do. You can't take calculated risks on certain amounts. I'll tell you where you should. Once you've solved all your problems, your retirement, there'll be money left over. And that can be used for all these risky things, because they may be, you can take a bunch of risky things. But I would say for the core goals, keep it really simple. Keep it with, the attitude that, over time, as a PMS, we get a lot of people's money where they are also in this zone. So we also are a little more careful of saying, listen, we're not going to invest in some random penny stock just because we feel that it'll give great returns. We have to honor the fact that our customers don't want to see this minus 40% in some stock and portfolio and all that stuff. So we tend to cull our universe into a point where we say, the risk is manageable in this universe. This remaining universe may be great. SME companies, somebody just pointed me this out and said, SME IPOs are making 70% a year. Great, fantastic. They can continue to make 70% a year. I will not participate. Not with my customers. It's just the way that I am. I might participate personally if it is money that I don't see a immediate end goal for. It's just plain old risk. That is fine. But you can't do this with people's money where they have given you money for relatively less volatility, long-term returns. So you want to be careful of that, because if people are selling you that for your core portfolio, that is a big problem. The second thing that I think people should be a little worried about, and maybe that's, so it's not just that the fact is that they're buying these complicated products, but they're also buying it in a way, in such a frazzled way, that if something happens to them, their next of kin will need like a lawyer, a chartered accountant, and a banker just to help them unwind all of this stuff. So you buy this stuff which is complex, it's in some bunch of things and all that stuff. Then you end up with a situation where it's not clear at all. So you spread yourself too thin and all that stuff. Now, spreading yourself too thin in mutual funds is perfectly fine. Because you know what? In the end, it's a bunch of mutual funds. It takes very little time to kind of solve them all together. Buying a bunch of stocks, fine. But you buy a bunch of AIFs or foreign securities and 500 different brokers and different this thing, because each one maybe they've come and helped you, they've got your ticket to the IPL and you bought some product from them. Over time this becomes a mess, so you want to bring this together. So initially itself, when you get the lump sum, you want to reduce your diversification to a certain extent. I won't say in general that this is always true, but I have seen this for almost every wealthy person, that there is a need to bring everything together and see a dashboard as a single place. Many times you can't see it because there are too many things happening and real estate is not really value. You can't put a value to it every time. But at least if you have it in one place, you know what to do for your legacy planning, for yourself also at a later point. Remember that things change very dramatically in the world. Today, suddenly they said we'll stop imports of laptops. Tomorrow they could say we won't allow you to invest abroad. And whatever money you do have abroad, please bring it back. Now, if you have, I hope they don't do that. I mean, I really hope they don't do that. Please don't listen. Whoever this income tax person is or government is, please don't listen to this part of the this thing. But if they do that, you end up with this, suddenly I have to work for nothing because I've done all the work to get it out. Now do all the work to get it back in the first place. So that is something that I would say sucks.
Do you have anything more people shouldn't do? Or I have one, but...
go for it.
I think that, let me phrase it. I think that you shouldn't do angel investing thinking that you're going to make a lot of money. I think that the reason people should do angel investing is because if you've got this exit, and maybe if it's a sizable enough exit, then it's sort of socially expected and maybe reasonably expected of you that you should support the same ecosystem that has helped you at this relatively young age earn such a large amount of money. I think that would be perhaps the only reason to do it. But you should kind of think of it as loans to family in that sense that, look, most of these are just never going to come out. One may or may not. But even there's the adverse selection that you're this small angel investor in a round or two, even if there's a decent markup on the valuation, the fact is the person who comes in to buy you out, you may be having to exit prematurely, even though ideally you'd like to stay on till perhaps at an end event. It's very illiquid. We're talking many, many years out. And finally, you have this adverse, why is this deal coming to you? Why do you have the opportunity? Now, maybe if you're you've gone to some very fancy college or you're friends with people from the same startup and they all know how to raise money, you might think you have some edge. And perhaps you do because your batchmates from college or your peers, colleagues at the startup are all very bright people. They know how the game is played and that might be your edge. But the fact is that I've seen many people make these investments and inevitably been like, this is just a barrage of paperwork. I have to endlessly sign on all these board resolutions, even though I have no share in this damn thing. And the payouts all adjusted and netted out are just not that high, even when people have been fortunate to participate in great companies. So my point is, maybe you have to do this, but view it as an obligation. I mean, again, all these rules have exceptions. As I said, if you come from the most amazing real estate family ever, or you yourself have a great eye for real estate, by all means, you will prove us wrong and make more money on real estate than we ever make on stocks. The same with startups. I mean, if you get 2 unicorns and you're their first check, I mean, you can laugh away to the bank. But then, as you know, you can say that of almost anything, maybe even cryptocurrency as of today, perhaps, who knows. Yes. But the fact of the matter is that, as a rule of thumb, you've got lucky and rich once. You don't have to do it again. You can now just kind of be boring about it.
Yeah, I think, and I tell this to founders all the time. It's like, I will never, even if I manage your money, I will never get the same returns you did. And there's almost no chance that I will. But the idea that a founder, by virtue of having had a great exit, can identify the next great founder, I think that is also a little bit, because so many factors, including luck and temperament and interest rates, then the Fed, which side the Fed chief woke up every morning, that affects your startup, right? And at some level, you can't predict it. So therefore, what happens is typically people try to diversify, put lots of money in. But this angel investing thing, I think you have more first-hand experience at it than I do, and I think also that when I see the relative liquidity of it, I think of it as, like you said, it's a charity until it comes back. And when it comes back, it's a bonus. So if that's the attitude, then subtract that from your net worth and say, I never owned that money in the first place. So if you get a 5 crore check, 5 crore payout, say I actually got a 4.5 crore payout, the remaining 50 lakhs is to, participate in some 10 or 15 companies at 5 lakh rupees each. And that's nowadays apparently what the check sizes are. Some cases they go to 25 or 30. But what is interesting is that this whole structure of angel investing is huge. It's like market cycles. When the market's on a tear going up, people won't invest in the stock market. When the angel investing exits are on a tear, everybody wants to do angel investing. Until they realize it's a very tough job, because your upside is X. And like you said, sometimes the upside is because you're lower down on the, pecking order of things. You don't get that much of an upside because everybody else wants to buy you out before the big upside comes. And on the downside, your downside is 100%, because once the company's gone, but yeah, I think very important for people to understand that this is not a sure thing. In fact, it's a totally unsure thing until you get some surety. So you want to invest, then do it as a favor, as a friend, as a payback mechanism, rather than like this.
I think we can move on to the fun stuff, unless anything is coming to mind or I don't say anything on our list.
No, it's always fun to get to the fun stuff.
So consumption.
Yes, I think. So here's the thing: the financial guys will probably hate me for this, but you shouldn't put more money into these investment kind of things than you should. That's because if everybody invested, where would the companies make money? At some level. But it's also another true thing that for real happiness, you're going to have to consume that money. That means whatever you do, whether you call it investing or not, saving for your son's education or daughter's education is essentially saving so that money can be spent when your daughter or son reaches the age of 18 or something like that. The same thing for everything else. What is called spending today is investing is just spending tomorrow. So if you reach a point where you've created this massive corpus and you've saved for your retirement, you're done, all that stuff is done, you still have some 10 crores remaining. What do you do now? My answer is do everything that you want to do, because I'm not even saying that this is now this is actually work, and this is good work, but this is work. Because if you ask somebody, what are you going to do when I get rich or something like that, they will say, oh, you know what, I will take a trip around to the world. I've never seen Western Europe and Argentina and the southern tip of the South America. Yeah, South America, which is, it's the way to Antarctica. I've never been to Antarctica. I've never touched, Japan, or I want to go to the Falkland Islands because people keep talking about the Falkland Islands. I don't know where the Falkland Islands are. I don't know. It's somewhere near Argentina, apparently. But you want to go to these places because but then when you get the money, you're like, no, because now you're looking at the expense number. Your earlier fund hours ticket to US is 40,000 rupees per person because you're traveling economy. Now you're thinking, oh shit, a business class, just one level upgrade to your lifestyle and it allows you to sleep, is 2.5 lakhs per person. This might still be acceptable.
I think that's one way perhaps.
That's one way I think maybe I'm also a little clueless about this. But then you could do the first class, which is, at 10 crores, you can easily do a first class trip to America and, come back. It'll cost you 40 lakhs just in air tickets, perhaps 40 or 50 lakhs.
Depends on the family.
Let's say, maybe 10 crores, a little less. But assuming that that's what you wanted to do, you should do it, because that's 10 crores extra that you have. It's not required that you keep it and all that stuff. If this is what you wanted to do, do it. Do do the things that you want to do, and things that experiences. So it's not just buying assets. Like you could buy gold and all that forever. But what if you really want to, travel to Switzerland, do bungee jumping off this thing? These are not expensive stuff. It's just that it's as expensive as you want to make it. You can go skiing. There's summer skiing in Norway, so you can actually ski off some place which is close to a glacier. So you can do summer skiing there. There is like I said, the southernmost tip. So the travel has food. Honestly, Shray, I think I have not appreciated the craziness that food can be and the happiness it can give you from various places as much as the times we've gone and you've shown me stuff that is incredible, because I always thought food is like, okay, you could get just better grilled chicken, which is approximately what, and all these other stuff is not this thing. But no, there is an art in the presentation and all that stuff. The problem is, if a person like me is looking at the amount you have to pay for anything, the immediate feeling is, oh, this is too expensive. And you got to get around that one feeling, which is that this is not worth it. Because even a 300 rupee coffee is not worth it. technically, because you were buying 10 rupee coffees and you were perfectly happy earlier. And you could tell the guy no sugar, it would taste close to everything else. But now because it's called Arabica coffee, comes in a fancy paper cup at Starbucks, you end up paying 300 rupees for it and you're perfectly fine with it. At some point, your incomes have gone to a point where this 300 rupees doesn't make a difference. And the 10 crores, the same thing multiplies by a 3,000 rupee or 3 lakh rupee kind of expense, which earlier you would have been paying a lot less for. And it goes to say in pretty much everything, whether it is assets of course will change, because you can see the differential between maybe a 14 lakh Maruti SUV and 75 lakh Mercedes SUV. Is not so dramatic unless you're a really fancy driver yourself. And your mind is probably thinking, dude, in Bangalore traffic jams, I'll be stuck in the Maruti and I'll be stuck in the Mercedes also. But my answer is, in a traffic jam, don't you want to be stuck in the Mercedes? I mean, do you want to just be miserable or rich and miserable? So I would rather be the second one, right? So I think that attitude, the thought process has to change, because once you reach the stage where you have a lot more money, this idea of lump sums always leads to lump sum investing. But I'm like, no, lump sum is consumption. Lump sum beyond do the basics. The fun part is, and so the restaurants in the world, the watching Wimbledon Centre Court if you're a sports fan, anything where the cost is ridiculous, do it, because I think it'll make you feel better about yourself and your life. And I think there was this Ramit Sethi thing, which was a big problem, which was, he said that he talked to a bunch of people who made a lot of money, and they made so much money, and they were struggling to justify like $100 meal per person. It's usually a $20 meal per person that they're used to, but now they're paying $100 per person and they were feeling miserable about it. And I'm like, okay. But yeah, I mean, this is true. It happens to the best of us that we've struggled all our lives living relatively middle class. What India calls middle class, actually the rich class. But let's say not the exorbitant lives, where you're saying, okay, no, I'm going to cut down certain. Because we had to when we were younger, but now that you have a large amount of money, you can't imagine yourself making that leap immediately. But I think it's a conscious leap you have to make, because you actually have done really well for yourself. So I think it's time to...
I think my abstractable thing here would be that spending your money is also a skill that you need to develop, especially if you need to there were all these things you said you would do. Now you should probably do them and see if you like doing them, so that you should know what you like and what money can actually do for you.
Yes, absolutely. I mean, it's like goes to say, you
go skiing the first time and you hate it, then maybe you realize that that's one whole thing you don't need.
Yeah, no, I'll tell you, the weirdest thing, like Sana started doing Rubik's cubes, right? So we started looking at cubes and we bought one for 200 rupees, and we said, 200 rupees for a Rubik's cube, that's great. Then he suddenly started getting skilled at it. And then once you get skilled at it, you're like, I need a faster cube. And you look at the faster cubes. He saw this and he said, Daddy, this is like 1,000 rupees for a cube. And I said, okay, if it helps you, let's go for it. He said, but it's 1,000 rupees. I said, your pocket money is there. You can pay for it if you want. And it's like, money that you can use. And you've been saving it so long. I said, okay, done. And then he went for this and he was struggling to get his mind around 1,000 rupee cube. And it was like... And now, recently, because he's gotten to a point where he's much better at it, and he wants to compete at the sub 10 second level or whatever that is, get to that level of skill. For me, this is rocket science, because I don't know how they do it. But so I take 3 minutes, and at 2.5 minutes, I'm the king of the world, right?
Yeah.
And at 2.5 minutes, they've solved the cube 10 times and gone for lunch. So now he's got a cube that actually costs more than 5,000 rupees. And he's okay with it now, because he's like, okay, no, this will help me get better at what I want to do. And so maybe they're right. The spending takes
learn what spending makes you happy, and the only way to probably do it is to spend a bit and be burnt a few times and realize that I never want to waste money on this again.
And sometimes it's
and sometimes I can do more of this. Achha. Anyway, enough about the money part. There was a whole other section you had, as an end to this, which was that if you've had a large enough exit, or people know you had an exit because they know you worked at, say, Flipkart, and Flipkart people got their exits, there's a bit of an emotional roller coaster that comes with this, and a slightly changing dynamic with the people around you. And you've experienced this as well personally, I think, and customers of ours have come and told you their stories as well. So could you just talk a bit about that? And maybe that's the note we'll end on, which is fine, enough about the money, but we kind of already knew that, or we could have read your book and we would have got that. What about the not money parts?
Yeah, that that is okay. Now this is where it gets a little complicated, because I think there are two kinds of bonuses, right? There's windfall bonus that comes at the end of the year. It's a bonus, it's going to come. Your salary is 25 lakhs. You got a 20 lakh bonus. Okay, fantastic, great. But it doesn't change my life meaningfully. But I get more money. I can pay back some loans. I can do some things and all that stuff. This is easy to understand. Does not change your life. But the 25 lakh rupee per year earning guy who gets 10 crores, that's a windfall. And now you're suddenly thinking, okay, boss, ab kya kar? Now you're thinking 10 crores. Now I paid 3 crores in taxes because of X, Y, Z, and I have 7 crores. I need about 50 lakhs to pay back some loan, 1 crore to pay back my home loan, 2 crores for the kids, and another 3 crores for my retirement. Guess what? How much I have left? Only 1 crore. Now I'd use that 1 crore to make myself happy, right? That's how I'm thinking of this from a financial perspective. But it never works like that. The unfortunate problem is the larger exits tend to make people, in a way, expect that you'll help them. And I heard a Morgan Housel podcast recently, and it was about this, about how Shaquille O'Neal, before he was drafted into the NBA, had already got himself a contract worth $1 million once. He took $1 million. He said, I have $1 million. I want to earn a Mercedes because, great set of wheels. So he goes and buys something $150,000 worth and gets it home and says, you know what? I've spent $150,000 out of $1 million. Sounds great. His brother asks him, what about mine? So they go and buy a Mercedes SUV, and then his mother asks him, what about mine? So he buys a 60,000 car. By the end of these little things, he's ended up with spending almost all of it, because he didn't account for the fact that $1 million has taxes on it. So he ended up spending all of that money very fast. Of course, he ended up quite well because he ended up going to the NBA
and becoming a legend. But yes,
but assuming that it doesn't work this way, think of how this works. The problem is Shaq was not living an affluent lifestyle before, so a lot of people around him were relatively poor. It does not work well for Shaq's own mind to say, I will be rich, but all these people will remain poor. It isn't that they're asking him. Many of them might ask, but it is that he himself wants to lift them up out of poverty. Somebody has a housing loan, somebody has an education loan. I'll pay it off. I'll help you out of this mess. By the time you've finished helping people out of their messes, you've helped them out of their messes. And unfortunately, many people find a way to get themselves into more messes afterwards, the chronic debt people. But regardless, it leaves you poorer. It does not leave them much richer. As in, it just uplifts their lifestyle for a certain time, but it does not really meaningfully change their lives. But this is an emotional roller coaster, because you can't not do it. You simply can't. You're in a lifestyle where not doing it affects you more than doing it, even though it is suboptimal, even though it is taking away. So instead of saving for your son's education and stuff like that, this becomes a problem. The only solution to this is to do these things, in a different way, to try and do it before these exit points kind of reach you. So get it done faster. But more, what's interesting is also that sometimes people will come to you and ask. You get a windfall, somebody will say, hey Deepak, I had this, and why don't you? So somebody may come to you and say, Shray, I need. We had a customer who said,
they had made 40 crores of a real estate
transaction, and somebody said, give me 1 crore.
It was just give,
not even a loan.
Yeah.
So why should I give you 1 crore? But because you earn 40. Somehow it's like
I worked with you. There was some sense of I've worked with you for all this, but not necessarily on real estate. Just
on real
estate
or something like that.
Yeah.
So it becomes. I think the problem with something like this is that you end up with a situation where people may ask, and you might find it difficult to say no. I think this problem of difficult to say no is also a learnt thing, because over time you will learn how to say no. It's just that you don't necessarily come inbuilt with that habit. And if you've just made a lot of money, possibly most people in the tech community are very soft-spoken, a little nerdy in that sense. So they can't just go and say, deny, I will not give you any money and all that. But that does have emotional baggage, because now when you say no, you feel miserable about having said no. And I think that you can solve by saying, I'll secure my family and myself first. And I don't know how you can do it, but is it possible to say, this money is gone?
I mean, lock it up away from yourself, I guess.
Yeah, and the government has figured out this is the problem in Indian society. So when they give you pensions, the idea is, you created your new pension scheme, the National Pension Scheme, NPS. When you finish your retirement, you have made 4 crores. But guess what? You can only use 60% of that money right now. 40% of that money is locked in as an annuity, and it's going to pay you over a period of the next, till you die, a certain amount of money every month. The idea is that they don't want to give you that big lump sums because it might get borrowed away. You might want to do things which are beneficial to other people but not to you. So they've tried to build that as a discipline by enforcing it as a rule. But I think you should enforce this on yourself, saying there's certain things I will not compromise on. I will not compromise on my family. I will not compromise on my longer term thing. So I also think, the part that is not fun is because when people get these lump sums, there is also an innate fear of spending it. And by the way, this leads into it, because once you start spending it with your friends, suddenly your friends might be like, oh, he's got the money, he's going to be the one spending it, which is fine, which is okay to a certain extent. But it shouldn't be at the expense of anything else. It should, because I'm happy to go out with my friends and pay. It's just the way it is, if it's excess. But if you're in a situation where if you did this, that it would affect the corpus that I have saved for my child's education, I think that is a bad idea for anybody to do. And this does not happen nowadays so often because we don't hear those stories. But in the past, and most lottery winners have this problem, because when they win the lottery, the first thing that happens is somebody comes and says, listen, you won the lottery, I have a home loan. Can I use some of your money? I'll pay you back over a period of time, but right now I don't have any income to pay the EMI that the bank is asking for. That's where it crushes you. But at some point you got to be like, I'll give you so much because that's what I have as excess beyond what I have, but I can't give you what I actually, even the consumption part, spend. It's a valuable thing. It's not like I have this extra money and it's available to lend to other people. It is, I have this extra money because I want to spend it for myself. We are not going to live that long in the overall sequence of things, right? So you get beyond your working days. Maybe that's why people love their childhood up till they're 18, and they find those years the most formative of their lives because they remember vividly how it was to be free. And you almost never get free really after that. So when you've got this money, you should enjoy that freedom in some way that makes you like a child again, right? So you should do it in as much fun as you want. So
I think maybe last thought we could have. Any thoughts about charity and philanthropy, if it's worth bringing up?
Yeah, that's the part that I think we should go down the value of. And maybe this rich and anonymous
I guess
thing.
this depends on the size of the ESOP payout, of course, because probably your charity can be just helping those around you, or in this case, helping those people who come to you for help.
Yeah. I think this is where I think it's complex, because charity, like everything else, is almost a full-time business if you want to do it right. And the problem with that is
work again.
Okay. So I think the issue that we come around with, and from a global point of view, we want to give back to society in different ways. But most of the time we end up with a situation which says we do have a situation where I am donating to something, and that something has to be meaningful right now. That means I have to fund that child's education. That's why I show you photos of children who need money. But when you give it, you're not sure you're actually funding that person or something else. I remember when I was in my first company, Agni, we got a contract from this government company, which was an NGO, and it was getting grants by the government. And they were like, no, we do this work. So I said, what work? And he said, no, we do this work that involves helping children. So I'm like, great, this sound, you must be getting a lot of donations and all. He said, no, we don't get donations because of how we do it. So I said, why is it different? So he said, no, what we do is we clean the houses and set up drains around the houses of people, of children, the parents of the houses of the children itself. And we do this in the forests of Mysore. Where people have these thatched huts and all that stuff. We make them pakka housing, we make them drains, we clean the environment, we help them clean the environment around them, and we give their parents food, and because the kids get food in school, we make sure the parents are given food. So I said, that why do you do that? He says, no, because we found that children will come to school if they're healthy, and if their environments around their house are dirty, they're not healthy. They'll end up having disease and not coming to school, and therefore losing the value of coming to school. We want to increase the participation in schools. Therefore, we do this as one of our activities. If their parents are hungry, the kids stay home. They want to work. Or the parents tell them that they have to work. The parents don't want to be hungry, and the kids don't want to see their parents hungry. So you want to make sure that happiness remains in the household. It's a relatively small amount. But guess what? When I go to people and we tell them that we do all these things, they don't want to fund us. Oh, you're giving food to adult people who can work? Why are you doing that? So the answer is, well, they're in a forest. They forage for food. There's nothing. There's no commercial activity there of meaningful sorts until we build it. So till that time, we have to help them by augmenting the stuff with food. It's probably their children who will build up the next set of things and all that stuff. This is, I think, an intrinsic part of the charity philosophy. That when you have a lot of money, you want to give money, but you want it to be meaningful, and that the kickback that you get from seeing that your money has helped somebody else is what makes you feel that the charity is a good thing. But my point over here is that you shouldn't care. That the mindset should be, I have donated. How that money is actually used and whether it's actually used in exactly the right way is probably less important than the fact that you have donated. As long as the other person is not using this money and taking it and saying, oh, we're just going to hoard it. I mean, that's like a donation to somebody else, but to another individual's this thing. As long as it's spent in roughly what you think will benefit and in any meaningful way. To me, even a Mukesh Ambani building in 8,000 crores is like charity, because you could have built it for 500 crores or 100 crores. But the fact that he spent so much is probably a whole lot of more money on stuff that he would have bought from local vendors, got a lot of local carpenters, local people. They got incomes where they might have not otherwise have got it from him, and it would be a lot smaller jobs that they would have gotten in a bunch of other places. So I think that is meaningful from that perspective. But the charity itself, I think another anecdote from my own side. And this was when I was just married about 20 years ago, a little bit less than 20 years ago. We were walking on MG Road, and I was like, there was this old person and who looked at it. And my attitude at that time was, if I see something, I have something in my pocket, I'm going to give it. And I had a 50 rupee note in my pocket. I took it out and gave it to this person. Somebody else came to me and said, don't give him that money. He is going to use it to have liquor. So I said, two things. First, it's my money. What difference does it make to you? And, I understand that you're trying to help me here. But do you know why this person needs this money? So he's like, no. I said, he could, even if he's using it, he could be using it for medicines. I've just given him the money. You have no idea what he's doing it for. The second thing is, what if he has cancer and the liquor helps him solve the pain a little bit and he doesn't have the money to go to the hospital and all that stuff? And my 50 rupees is not going to change anything for him. The liquor might. Why doesn't it? And 50 rupees was a lot in 2004, 2005. So that's roughly. So the guy was a little stunned, but he says, but don't you want to know why he's using the money? I said, no. Once it's gone from me, my act is over. Beyond that, he can do whatever he wants with the money. He could go gamble it. I don't care. As long as it has given him that little bit of happiness, and it's given me that little bit of happiness, to see that little bit of happiness from his side, it's over. I don't want. But charity by itself is complicated. But the minute you have a lot of money, and there's probably an optimal level, okay? Maybe, and before we come to that point also, I think before we come to this charity, this angle of it, there is this upper limit beyond which you feel that you have to benefit society because you have so much money that you must benefit society. But before that, I'll come to another part. And this is where it's complex because it's the same rule as charity things. We often look at, investments and say, okay, this is a regular plan. It pays 1% more. And the direct plan costs 1% less, and therefore I'll make more. But what if I told you that there are lots of distributors who help their customers stay on track, and that 1% you pay them is worth more than 1% in the longer term simply because they've helped you stay the course. The fact is, and I have been guilty of telling people all the time, no, go to direct. But I am not the person who's helping them stay when, and it costs money to help people stay. It costs money to service customers. So obviously that 1% is usable in some meaningful way. And that 1% is meaningless when you're smaller. That means the 10,000 rupee guy is also paying the same 1% as the 10 crore guy. So you need the whole spectrum to be able to make a business out of this. So, and I value that. I mean, I think we should value that advice. But the same way we value the 300 rupees coffee today, it obviously doesn't cost 300 rupees to make that coffee, but obviously now you. So I think this is in a way also thinking of yourself one level beyond, saying, I'm going to get a benefit out of this. It does not matter that this benefit comes from X or Y. I would say don't do it if it's entirely wasteful. When I say that, I don't mean that when you can't appreciate the return for it. So, for instance, you get somebody who's given you advice, or not even given you advice. You went to a bank and said, I want to buy this mutual fund. And that person says, okay, and buys the mutual fund. You still pay the 1% commission, but then the guy never helps you. Yes, okay, that is a waste of the thing. But beyond that, where there is a help that's needed, I don't think we should grudge anyone the aspect that comes in there. But coming back to the charity part, and this is where the money becomes important. Once you get to a certain level, I think, and you probably have seen, I think there was a graph somewhere. We discussed this at the time. You're happy, you're unhappy when there's a graph like this. So this is a graph of happiness, and on the y-axis, and on the x-axis there's the amount of money you have. So the less amount of money you have, you're not very happy, and as you get more money, you're linearly more happy. At a certain amount of money, the happiness does not increase. You're just the absolutely highest level of happy. And then beyond a certain point, the money becomes a burden. And then it starts dropping. And then this dropping feeling is like, dude, I have to do something. This is like so maybe that number was 100 crores 5 years ago. Now it's probably 500 crores. If you get 500 crores, what are you going to do? I know this is probably like, the people who listen to the podcast are saying, 500
like two
crores.
people listen to this podcast.
Yes. But it's possible that a lot of you are exposed to that kind of money at some point. And that is when, and this trigger may happen even at 20 crores, even at 25 crores, that I have to give back to society, and suddenly it becomes a burden, because now you're like, should I give it to a cancer repair thing, or why should I fund farmers to get organic seeds? I don't know the answer to that. And that suddenly changed your money from making it work for you. So now again, you're going back to working
for money. And that's perhaps the one thing you want to avoid. So I think the joke we can end on is, you make hundreds of millions of dollars, but not the billion, because then you'll have so many responsibilities over you. Chalo. So Deepak, let's call it a close. Thanks so much. And for everyone listening, thanks for hearing this. If you have any ideas, feedback, or suggestions for new podcast topics, then just email them to podcast@capitalmind.in. Thank you.
Cheers.
Folks, we'll end our episode there. We had recorded a bit more about the non-monetary parts about dealing with a payout, but we'll save that for a separate episode, so apologies for the slightly abrupt ending. Thanks so much for listening. If you've had an ESOP exit or some other form of payout and find yourself dealing with a lump sum, then why don't you take a look at our website capitalmindwealth.com or email us at connect@capitalmindwealth.com to learn more about our PMS service, where we can take on customers who have more than 50 lakhs in assets. If you just have feedback or ideas about this podcast, then send those over to podcast@capitalmind.in. Till next time.